Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi. And I know you're just back off vacation, so welcome back to you as well.
Well, thank you very much. I'm very excited to get back into it. And what a thing to come back to, your monthly review and outlook for August, which is obviously available on Substack at hugeinsights.substack.com. And of course, everyone, don't forget to like and subscribe to Your Finance TV. We're through 3,500 viewers, subscribers. So it's growing day in, day out, week in, week out. So thank you very much for your support. So, Jeff, obviously, it's been a couple of weeks since we spoke, and we've got your big piece out. So I'm dying to dive in. So let's kick off with top down as usual.
We're super focused on trying to find tactical ideas for our subscribers, whether it be sector rotation, whether it be ideas, both on the long and the short side. So as you know, that's really kind of our go-to is working with hedge funds, long short funds, long only investors who are looking for tactical positioning ideas, whether it be fixed income, equity, or long short equity. And that's kind of where we made our bones in the business. As a side hustle, we try and predict the market, but I don't think we're any better at it than anybody else, Eddie. And clearly for the second quarter, we've got mud on our face. Just to be honest, I mean, we have been looking for this counter trend advance to top under 4,200. And when we broke out in May above that level, we never expected the rally to carry to 4,600. So that was shocking to us. We owe all of our subscribers a big apology on that because we got it wrong. And honestly, I don't know that our thesis is wrong. I just know that we didn't catch that breakout. And every step of the way up, even though we moved our targets up, the breakout above 4,200 got us to 43.25. Then the breakout above 43.25 got us to, I think, 45.74. And so we'd adjusted targets and there was a trading opportunity, but clearly it moved way beyond what we expected. And at this point, I'm going to go out and just say it. I think the market topped on July 27th. Okay. I think primary wave two up, which was a counter trend advance off the October low, topped on July 27th. And we are in the very, very early stages of primary wave three down. And, I think there's a lot of evidence to support that. And we'll see how it all plays out. But this is how we're positioning. We are recommending investors sell them if you got them. And, if you're sitting in cash, be patient. Okay. And when I mean sitting in cash, obviously you're not sitting in cash, right? But do you have cash reserves above average cash reserves, which is what we've been recommending? I think that's a good place to be. If you got to be long stocks, you want to be tactically focused on high relative strength right now. But I don't think you need to make a market call. I think market neutral is the right place to be from a long short perspective. And if you're a long only investor and you're trying to minimize net equity exposure, there's a lot of ways to do it. You can sell stocks and buy calls, right? That's raising cash. That's limiting your exposure to the market, but still maintaining, some exposure to any potential upside that might still exist. We think that's going to be very limited if it exists at all. So that's basically our message, Mehdi.
Well, thank you for clarifying that. And it always takes a big man to accept some of the situations that might not go on your way. So, thanks for that, Jeff. Let's dive right into your monthly piece because there's a lot to cover. As you said, 88 pages, but we've got a condensed version here today. Let's kick off with the cycle composite model. It's been looking a little bit toppy here.
Yeah, Ned Davis Research does a nice job of combining these three cycles. It's the 1-year seasonal cycle, it's the 4-year presidential cycle, and the 10-year decennial cycle. And what they do is they equally weight them and aggregate them together into a single cycle line. That's the solid blue line here. And it's a pretty good, roadmap to how the market has traveled historically, right? Looking back to about, I think 1928 is as far back as their data goes. So, what we can discern from this is that, the cycle composite reached its peak in mid to late July. That's consistent with our view that the market topped on July 27th. It is slated for a correction into the late November time period, and then it should bottom and move higher. Now, again, this is a historical average of cycles, right? This is what we can expect. What we're thinking right now is that, okay, if we're right that this is a counter trend advance, then we're going to see a fairly significant decline between now and late November, consistent with this cycle composite. The flip side of that is, if we're wrong and we are in a new bull market, and I'm not seeing enough evidence yet to support that conclusion, it will represent a buying opportunity. And we'll know it's a buying opportunity if we don't get a specific break. If we don't break back below, say, S&P 4,300 by late November, then it's a pretty good guess that, you know, it's a correction, that's an opportunity to buy the dip, so to speak, and get long the market into something that's going to probably be a more extended upside potential. So, you know, we're looking at this two ways. Number one, we're either going to get confirmation, or number two, we're going to get a buying opportunity.
That's very interesting. And obviously, we'll look at the bigger picture along the way this today as well. Can we have a look at the liquidity dashboard? And are we seeing any major changes in this as well?
I wouldn't call it a major change, but I would say this, that, you know, year over year growth remains negative, albeit less so. And bear in mind that this is a real M2 money stock rate of change, right? So that means it's inflation adjusted. And what's occurred over the last couple of months? Well, we've seen the inflation numbers come down dramatically, right? And so that was expected. It was driven by base effects. And as a result, we saw that negative 9.1 record low that we printed, I think, back in May, actually migrate a little bit higher to negative 6.5, which was the prior record low, right? So it's not like we are making enormous progress, right, on this front. M2 growth on a real basis year over year remains negative, and it remains substantially negative based on history, right? And so that is a headwind for the market, and that's something that we think will continue to pressure stocks to the downside going forward.
So, Jeff, when we look at the economic conditions dashboard here, it's been a pretty good guide for recessions. Everyone's talking about soft landing, no landing, hard landing, whatever it is. Are we still pointing to recession? Because everyone's saying this could be the most widely telegraphed recession in history at this point.
Yeah, you know, it is. There's no question about that. Everybody's been anticipating a recession. All of the stars are in alignment for a recession. And the problem is, you know, you've got two bodies of government at odds with one another. You've got, you know, a fiscal policy stance that is just pouring gasoline on the fire, so to speak, with legislation after legislation that's slated to pump in excess of $1.5 trillion into the economy over the course of the next 10 years, you know, focused on infrastructure and things of that nature. So that's actually stabilized employment, or certainly, you know, created some pressure, upside pressure on employment. And that has made the Fed's job more difficult. And as a result, the Fed has been somewhat more aggressive than a lot of people anticipated. We're now at about 5.5% on the Fed funds rate. And have we entered restrictive territory? It looks like the real Fed funds rate is now moved to a positive level. And that suggests that we're now actually in restrictive territory. So, you know, the point is, you know, when will this recession arrive? It's been like waiting for Godot, right? Well, the LEI index has probably been the best predictor of a recession in history. It's got a 100% track record. And the LEI index, when it breaks below negative 4% year over year growth, that usually signals a recession within the next, say, 6 to 10 months. So we use kind of an average of 8 months. That would have put us squarely in the second quarter. Well, it looks like it's dragging on toward the long end of that. Our suspicion is that we're going to start to see evidence of recession building in the third quarter here, and that the LEI index, which actually ticked down from its May uptick, we get the data about a month in arrears. So we just got the June data, and the June data was another downtick. And so, the view here is that, it's highly probable that we're going to see a recession materialize in the subsequent 12 months. And so I said, basically I said the clock started ticking in July, right? At the beginning of the third quarter. And I think that clock runs through the end of the second quarter of 2024. That's the 12-month time horizon that I think is most probable to see a recession materialize.
It's interesting, Jeff, because some of the commentary coming out of these Q2 earnings at the moment are kind of in line with what you're saying, what some of the corporates are seeing as well. So, we'll definitely watch that closely. While we're talking about the Fed and inflation, looking at the underlying inflation dashboard, are things coming down enough to make the Fed happy?
Yeah, it's a good question, right? The headline numbers come down into the threes. That's a good thing, right? Takes a lot of pressure off the Fed, gives them a little breathing room. The problem is that the core number has remained above 4, and the core inflation rate is being pressured not by goods prices, not by commodity prices, but by services prices, right, as well as labor. And so these two factors are extremely sticky. You give a guy a raise, you can't take it back, okay? You hire a guy at $15 or $20 an hour, you can't cut his pay, okay? And expect them to stick around anyway. So, at the end of the day, that is going to be a little bit stickier to the inflation equation. And that's where the Fed has been focusing their attention on the core PCE, which is now around 4.1%. I think if we really look at this dashboard, which comes from the Atlanta Fed, it takes a look at 9 different calculations of core inflation, and it looks at it from a lot of different angles, right? And if we just aggregate the latest reading, we can see that we're about 330 basis points above the Fed's 2% target. Now, that's a self-imposed target. They could change it. They could say, well, why not 3%? The economy's hummed along in the past at 3%. Maybe it can do so again. But they've been adamant that they want to get core inflation back down to 2%. That means they've got about 330 basis points more to go. What's interesting to us, and this number's been declining kind of month after month, but the number of these calculations that continue to have significant year over year, increases, right? In other words, the level that is current in these calculations is substantially greater than it was a year ago. So, these prevailing levels need to come down a lot in order for the Fed to be able to declare victory. I don't think we're there yet. And, I think it's something that remains to be seen, right? We'll know in the fullness of time, as they say.
So do you think that the Fed's done hiking?
Yeah, I think that's a great question, too. The street seems to think so, but the street's been dead wrong almost every single meeting, right? So, the Fed took a pause. They basically said they were going to take a pause, and they came back in July. They raised 25 basis points. They basically said they were going to do that. Now they said, we're data dependent. The street says, well, with about an 82% probability last I looked, that, yeah, they're going to pause, right? They're not going to raise at the September meeting. Maybe they don't. Maybe it takes them another couple meetings before they do. But I would not be surprised if this thing goes until the Fed has to get to around 6% on the high end of the range. So call it 5.75%, 6% Fed funds rate. That's a level that some really, really smart people were bandying about, 12 months ago, among them Jamie Dimon, and they're not deviating from that. And from what I can see with this core PCE, especially in the face of 2 things. Number one, this infrastructure spend that's going to be persistent for the next 10 years, and the current increase that we've seen in oil prices, right? WTI is up some 20% in the last month. Why is that? Well, the Fed, or I should say the government has drawn down their SPRs to levels not seen since the 80s, right? So I think 1983. And so they've got to build those back up. The expectation is that they have contracts that are expected to see delivery in both August and September already. It's possible we'll see more. And so, that is, the government's bid for crude oil at this point to rebuild up those SPRs is part of the factor that's driving the oil prices higher. And that's going to put a little bit of pressure on core inflation as well. So, I think at the end of the day, we will continue to see the Fed kind of, keep turning the volume up, so to speak, until they get what they're really looking for. And that is a break in employment.
And, so just to wrap that, we could potentially see another 25, 50 points in the hikes.
That's what I'd say, yeah.
Okay, great. An inverted yield curve has also preceded multiple recessions. We've discussed this over the last several months as well. Are we seeing any signs of a re-steepening?
We are. And again, we talked about the LEI being a great predictor. The yield curve is every bit as good a predictor as the LEI. Since about 1966, it's predicted every recession that we've seen occur. And the problem is it has done so, with long and variable lags, right? So we get these inversions, right? The inversion's kind of the shot across the bow, right? It tells you, there's a recession on the horizon. What it doesn't tell you is when, right? Well, when the curve begins to re-steepen, that's when the torpedoes are in the water. So I think at this point, we've seen a pretty significant re-steepening. Actually, if you look at the 10-year 3-month curve, that's re-steepened by about 50 basis points off of its April lows. And if you look at the 10-2 yield curve, that's also begun to re-steepen. That's re-steepened by about 15 basis points. So, I think the combination of these two yield curves beginning to show evidence of re-steepening is a pretty good indication that the torpedoes are in the water. And, I think the stock market up until yesterday's sell-off looked like the attitude was damn the torpedoes. Well, I think that attitude is going to change and will likely change in a hurry once we start to see some of the data.
So thanks for that, Jeff. Can we talk about the bull market of 2023 and ultimately why you're not that impressed?
Well, it's a market of 7 stocks is the way I see it, Eddie. You've got the Magnificent Seven, which we've talked about ad nauseum here, up, some 22.2% year to date. Yet the S&P 500 is up just 20.65%, including dividends. Okay. So, the Magnificent Seven's return is 112% of the S&P 500's return. If you look at it on a cap weight or, index weighted basis, right? And that means that the other 493 stocks are actually down 1.5% year to date in aggregate on an index weighted basis. I looked at it a little bit differently too. I looked at what percent of stocks are actually up over 20%. The TV media's definition of a bull market happens to be only about 28% of stocks. The next tier is about 20% of stocks are up 10 to 20%. Another 20% of the S&P constituents are up 0 to 10%. And then finally, 32% of the stocks in the S&P 500 are negative. They have a negative year-to-date return. That, to me, flies into the face of what a bull market's all about. You can't have more stocks in the index negative than you have up over 20% and call it a bull market.
So let's talk technicals. Can you update us on your levels and a preferred Elliott wave count?
Yeah, so we've counted this from the January 4th high last year, right? So the 2022 peak marked the end of what we believe is super cycle wave 3. And so we're in the midst of a super cycle degree counter trend corrective sort of movement. That's going to be a 3-wave move. It's A, B, C, and we're in wave A, cycle wave A down. And cycle wave A will be 5 waves. And so far, we've only got primary wave 1 down and primary wave 2 up. What will follow is primary wave 3 down, primary wave 4 up, and then primary wave 5 down to complete cycle wave 5. That will end wave A, or I said cycle wave 5 meant cycle wave A, and that'll be followed by a counter trend advance, cycle wave B, which could retrace something like 50% of that entire decline. Now, we expect cycle wave A to carry all the way down to S&P 2250. There's good reason to believe that it will hold this, kind of coinciding levels of support or aggregated levels of support that come into play there. What we're thinking about right now is that, this textbook decline off the Jan 22 high traced out what looks to us to be a leading diagonal of the expanding variety. And we found a textbook clip of it and we put it in the chart just to say, this is right out of, Robert Prechter's Elliott wave principle. It's absolutely a textbook chart, right? It meets all of the criteria. And now the corrective waveform that we see is an ABC. And we've actually adjusted our count to account for this wave in the middle as being a flat. We think it's an ABC flat that finished wave B. And that wave C really just saw an extension from both the fifth wave and the fifth of the fifth wave. And so, it's almost like a double extension. And that narrowing, tightening advance into the highs that we saw just on July 27th at around 4607 on the S&P, that we believe marked the top. It was a retracement of about 84%. Well, what we find is that it's very common for an expanding version of the leading diagonal pattern to experience a 88.6% retracement. And so we're right in the middle. We've retraced 84% of that. It meets the textbook definition of this pattern. What follows primary wave 2 up is primary wave 3 down. We expect primary wave 3 down to carry the market probably into the mid 2000s, right? Initially, we've got a range of around, I think, 2,400 to around 2,800, in round numbers. So somewhere in there, which really just is a 138.2 to 161.8% extension of the entirety of wave 1 down, coming off that wave 2 high. So that's how we kind of arrive at that level. And I think it's a pretty good range. We'll see what happens. Now, a lot of people have been talking about two things. Number one, well, breadth is expanding. We're seeing, a lot more stocks participating. Well, yeah, we're seeing a lot of S&P stocks participating. We're not really seeing mid caps and small caps breaking out, right? And in fact, even the S&P 500's equal weight index has yet to close above its February 2nd high. And so that being said, I think, what we're seeing in the AD line, for example, NYSE stocks, made a new recovery high, and that was confirmed by a new recovery high in the advanced decline line. Not a new all-time high, just a new recovery high. The opposite is true in the NASDAQ composite. The NASDAQ composite's made a new recovery high, but the NASDAQ advanced decline line has failed to confirm it. And so, that mixed sort of signal that we're getting from breadth at this point might really just suggest that we're seeing a rotation under the surface of the market out of growth and into value. That's our take on it.
So, Jeff, we keep talking about volatility, and it hasn't been coming, and then yesterday we did see a little spike, onwards and upwards in this.
I think so. Volatility closed the month of July. This is the VIX, CBOE VIX index closed the month of July out at about 13.6%. That wasn't an all-time low, but it was very close to a recent closing low. Yesterday we saw a spike to above 16%, and it broke the trend line that had been in place, and also broke out above the 21-day moving average, and got back above that 2021 low, which kind of had been where we'd broken below. So all those things together tell me that there's been a change in kind of the character of volatility at this point. What's also interesting to me is that the skew index, which has been elevated for some time, is starting to show evidence of coming back down. Now, a couple of explanations for what's going on here. Why was it so suppressed for the last couple of months? Well, I think what happened here is, the breakout in the Magnificent Seven caught a lot of options market makers offsides, right? They got kind of caught up in a gamma squeeze. And what that really means is that, every time somebody lifts a call option, and there's a lot of guys buying these 0 DTA daily call options on the S&P 500 or on those Magnificent Seven stocks themselves. It's really forcing the market makers to buy the stocks outright or buy the market outright in order to maintain a neutral hedge book, a delta neutral hedge book. And every time we see these stocks moving higher, they're forced to chase, right? And that's called the positive gamma squeeze, right? And so that gamma squeeze almost is a self-fulfilling situation where it just carries the market higher into this point where it runs out of gas. And that's where we are today. What's also been happening simultaneously is a lot of people who have been hedging were sick of watching their premium just decay and their hedges just kind of expire worthless at the end of every options expiration. And so in talking with a lot of large accounts, what I've found, hedging accounts, is I've found a lot of guys have been putting on a classic put spread strategy where they're selling they're buying a nearby put strike, right? Say maybe S&P 4400, and they're selling a deep out of the money put strike, maybe 2 or 3 bars in order to fund it, right? So they're selling the 3800 strike on the S&P to fund their put, and so at the end of the day, that classic sort of put spread strategy has put a lot of pressure on the long, or I should say the out of the money sort of part of the curve, and so that's kind of put the skew up where it is today. And so that situation, that selling the extreme volatility, has artificially suppressed volatility and kept the skew out of balance. I think where we're at today is we're in a situation where volatility is breaking out and skew is going to be breaking down. And we're going to see those alligator jaws snap shut over time. And that could be a fairly compressed period of time. It might be the month of August, for example.
Jeff, you just touched on the option side of things. So the put call ratio has been on the decline. What is the actual significance of this and what you're seeing?
Well, I think the significance of it is it shows extreme complacency, right? We got on an intra-month basis, the put call ratio, this is the 10-day moving average of the equity put call ratio, got down to 0.39. That was an extreme low. And so, when we get to that sort of level, it shows extreme complacency. That was, middle of July, so to speak. Over the last couple of weeks, we've seen that come back in, and we closed at 0.56. Well, even 0.56 is, pretty complacent. It shows that, basically option traders are buying 2 calls for every put that they're buying. Okay. And so, I look back to kind of the October 22, where we saw this kind of extreme upside push, where it's like 1.2 to 1, on the put call ratio. And it looked like, wow, people are really bearish. They're buying 1.2 puts for every call. That doesn't really seem too bearish. And I thought, well, it's kind of anomalous. I mean, we're not, it's probably not saying anything. Well, I probably paid a little too attention to that, too little attention to that. And I'm not going to pay too little attention to the extreme we got in July. I think the way to interpret this is that, it's confirming the wave 2 peak that we're seeing in the S&P 500 at this point.
So, Jeff, obviously we're in the midst of Q2 earnings right now, but everyone's talking about valuations and such. Do you feel that valuations are putting a cap on the upside potential of this market?
I do. I mean, I've been saying it for a while, but it's mostly based on some work I did back at the Luthold Group, where we looked at valuations based on decile over the history of the S&P 500. And what we found is that when valuations are in the 10th decile, you get the worst forward returns. We get forward 10-year average annual returns of around 3.25%. Well, where are we today? Valuations are in the 10th decile across a variety of metrics. Forward earnings PE, the Shiller Cape ratio, which is now at 32 times, price to book, which is 4.5 times, just off its all-time record high of 5 times. If we look at price to sales, we're at 2.6 times, down from the record high of 3.1, but still well above where we were during the, say, March 2000 epic peak, right? And then finally, you look at the dividend yield at 1.5%, and that's plumbing its 2000 lows as well. So all of these metrics are ranked in the 10th decile of valuation. Even if we look at market cap to GDP, it's 172.6% right now, way above where Warren Buffett would say there's a good value. So we're basically at a point in valuation where forward returns on the S&P 500 are a fraction of what would be expected from a 10-year treasury if you bought a 10-year bond today.
So Jeff, let's have a look at some positioning. Obviously, you go into a lot more depth within your piece, which everyone should subscribe to and read. But are there any sectors that you want to discuss that jump out at you?
I was particularly impressed by energy last month. I mean, obviously, we saw a huge move in WTI up almost 20%. Actually, it was maybe more like 15% during the month, but since like late June, up 20% into yesterday's close. I think that the energy companies themselves benefit from higher energy prices, so that's going to impact earnings. And we have seen some deterioration in energy earnings performance over the first 6 months of the year. And the reason for that was because the Biden administration was liquidating the SPRs and putting pressure on crude oil prices in order to keep gas prices low. And so, that was basically pressuring earnings for energy companies. That looks like it's poised to change. And my suspicion is we're going to see, WTI pushing up around $90 a barrel before year end. And I think the energy space itself can benefit from that. I would be surprised if we don't see a follow-through breakout from energy stocks to new highs. I'd be looking to position long around the energy patch, to participate in that going forward.
Very interesting. Noted. You're also bullish on the dollar in your macro asset classes. Where do you see the dollar index going?
Well, this is a call that we made a while ago, and we did not expect the pullback to bring us back into, kind of par value. We got up around, I think, 114, 115 on the dollar. We pulled all the way back to basically par. And now we're around 102 and change. I think that's indicating that we've put in a fourth wave. We've kind of detailed the Elliott wave count on the dollar. Currencies trade very, very purely in Elliott waves. The fundamentals are kind of difficult to grasp for a lot of traders on a short-term basis. They're really kind of very big, grandiose sort of things. And so, it's more driven by emotion. And so that's what Elliott wave is good at, picking up behavioral conditions. And so I think if we put in a fourth wave low on this Elliott wave count, the next move is to 120. And that's the count that we would get from a measured move based on the breakout that we saw late last year, early this year. And so our view is that, we're in the early stages of the final wave of this move, the fifth wave, and that should take us to a peak where the dollar could hit, say, 120, and that's where we would be looking to change our view.
Right, 120. Jeff, before I let you go, you close your monthly piece with some food for thought. Talk us through this, what we're looking at here.
Yeah, sometimes I use a technique that is known as point and figure analysis. It was taught to me by a fellow by the name of Alan Shaw, who wrote, a book on it. It's actually more of a pamphlet. I actually have one of the rare copies of that pamphlet autographed by him. So I guess I'll call it a first edition. But, I studied that in great detail about 20 years ago and became enamored with some of the, virtues of point and figure analysis. And, there's many reasons that, we can look at any form of analysis, we can find some holes in it. But the one thing that strikes me about this is that it's very good at identifying future price targets based on time and space, basically. And, the thing that I note is that the bullish price targets that point and figure analysis are projecting for both the 2-year and the 10-year are substantially higher than they are today. We're looking at a 2-year price target of 13.5%. That's the yield on the 2-year treasury. And for the 10-year treasury yield, we're looking at 10.5%. Now, this is not time specific. I have no idea what time frame this could occur over, and neither does anybody else. Point and figure analysis doesn't really project around time. In fact, time is eliminated from the analysis altogether. It's supply and demand, and I am less sanguine about the likelihood that we'll get a 2-year yield of 13.5%, because there's a lot of overhead resistance or supply that comes into place in the 9.5 to 10 range. But for the 10-year bond yield, that same overhead resistance and supply comes into play around 10% as well, and that's the target. And so I could see the 10-year Treasury getting into that 10%, 10.5%, years into the future, right? Baby steps, right? The next step that we're looking for is 5.25%, 5.5% on the 10-year. We think that's a achievable objective in the next 12 months. Okay, 10.5%. I have no idea when or if the market will make it to that level, but like I said, it's food for thought.
Well, Jeff, I'm always learning stuff from you, so I appreciate that, and I'm sure our viewers do as well. And I want to thank you for sharing your thoughts from Alpha Insights.
It's always my pleasure.
As always, I want to thank our viewers and urge you to check out Jeff's content on Substack. It's hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.